We're going to work on Nash Company's equity events. And what's a little bit different about Nash is we have opening balances for the year. So it's not the first year of operations. There's a history prior to this year. But they don't give us all the amounts. Look, we're missing what goes in the par account for the preferred and for the common. But we know the rule for what to put in the par account. You always have to put par value times the number of shares issued. So we can figure this out. So the par for preferred is 100. So this must be 100 times the number of shares issued. What would this be? This would be par times the number of shares issued. Additional paid-in capital, this 200, is what was received above par for the preferred and the common. So now we can put the beginning balances down here in our partial accounting equation. This is just the equity section of the accounting equation. So the beginning balance for preferred, par account, the beginning balance for common, and so forth. This methodology is good for keeping track of how to get to the new shareholders equity section. So if you have a beginning shareholders equity section and some transactions, this is a way to keep track so you can build your new equity section. Okay, so what are the events in 2011, the year that we're addressing? We issued 500 shares of common at 14. So we have to put par in the par account. So for each of the 500, we have to put par in here, and par was $10. But we didn't get par. We didn't get $10. We got 14. So the excess, that $4 above par, would go in here. So 500 times the 4. And so these two added together would be the $14 that we got. The next thing they did was reissue some shares. We already had shares in Treasury, as we see here, and apparently they're going to reissue some of those shares. So that's going to reduce our Treasury stock account and by the amount that was reissued. So next, we're going to handle the reissue of some shares at $20 a share. When you reissue, you must remove it from the Treasury stock account at the price it was put in. And any difference either is excess paid-in capital if you receive more than it cost you to repurchase them, or you remove it from retained earnings if you didn't get as much as it cost you to originally issue it. So let me show you what I mean. So let's go up here and see what the original Treasury cost. Let's divide that by the number of shares there. So each of those shares on average cost $20. So we must remove the shares at the $20 that it went in. So let's remove 400 shares times 20. And in fact, that's what we got when we reissued. But here we didn't have a difference to have to work with. Okay, net income, $60,000 would make retained earnings go up. And there were no dividends paid for the year. And there was no transactions with the preferred. So at the end, let's add these up. Now we've got the ending balance in these various equity accounts, and now we can build the shareholder equity section in good form. So let's see what that would look like with all the details added. So here I have the shareholder equity section built with all the details added from the balances that we just computed. So I have the amount for preferred, and notice I put the full description of the preferred shares. I include the number of shares authorized and the number of shares issued. For the common, I include the full name, the $10 par. I include the number of shares authorized and the number of shares issued. Notice the number of shares issued went up by the shares we issued during the year. So it used to be 9,000, now it's 9,500. Paid in capital excess of par has been updated for the new amounts. And total contributed capital has been computed, which is the three things added together: the par and the preferred and common and the paid in capital in excess of par. Retained earnings is added and treasury stock is subtracted in getting down to total equity. Remember that treasury is a contra account, and this is an extra little clue here.